Chapter 6 is intended to provide a broad overview of product costing. The accounting process begins with the accumulation of potential product costs in balance sheet accounts such as raw materials, labor, and overhead. Debits to these accounts increase the balances, which later on can be allocated to various types of products. In a job order costing system, the actual cost of production end up in accounts like work in process. A debit to the work in process account and a credit, say, to raw materials is how you transfer costs from raw materials to work in process. The arrows in the diagram show the flow of costs as costs go from raw materials, labor, and overhead to each of the potential product accounts. Costs, however, don't stay in work in process. Eventually production is finished and costs are moved further down the line. Cost flows are accounted for by a credit to work in process account and then a debit to finished goods account. When goods are sold, the costs move out of finished goods and on to cost of goods sold. Here's a quick review of some of the decisions that the accountant must make in this process. The first decision, of course, is whether a given expenditure should be put on the balance sheet or written off as an expense. If the expenditure, say on materials, is a product cost, then it comes out of raw materials and then has to go either to work in process, a direct cost, or perhaps can get charged to the overhead control account, an indirect cost. Indirect costs are a problem for accountants. In a later chapter, we'll learn about actual and predetermined overhead rates, but the main idea is to figure out a proper way for taking costs out of the overhead control and allocating them to the various work in process accounts. In some cases, a more accurate picture of costs can be determined by using multiple overhead accounts.